Welcome to the big show. This is Investing with Confidence. I am your host, Joshua David, and we are happy to have you with us today. As always, I have my great friend, my great pal, and he is always drinking coffee, Mr. Al Connickson. Al, how the heck are you doing today?
I've had my coffee. I'm feeling pretty good. All set to go. Looking forward to a fantastic 2021.
You're right. With all that coffee you've been drinking, are you having an okay time sitting in that chair? Do you sit down, Al? Come on. Now.
I really don't drink that much coffee. I may take a small sip here and there.
It's always great to be back helping our family make better investing decisions. And Al, as you said, we want to start the year off, and we've been talking about this the last couple of weeks here, with a bang. And the market really has. The first trading day of the year was a pretty big down day. I believe it was 1 or 2%.
Yes. Yeah. It was somewhere between 1.25% to 1.4%, depending on which index you're looking at.
Exactly, which really spells opportunity.
Yep.
A lot of people think, oh, that was a bad start of the year. Well, heck, it was a great start of the year if you understand the different techniques, the different concepts as far as how the markets really function in both directions, up and down. And that's some of the things that we're going to talk about here today on Investing with Confidence is how we can participate no matter which way this market goes. And Al, let's recap what's been happening, I guess, the beginning of the year, some of the different highlights there, but also some of these opportunities that we're seeing.
Well, you mentioned that first day of the year when the market was down so big. People look at a day like that or look at a bear market and they look at it as a bad thing. It's not a bad thing. It's just an opportunity in a different direction. And you can be assured that there were a lot of people that did extremely well on that day, that first day of the trading or the first trading day of the year. Even back in 2018, there was a day when the Dow was down about 1,000 points during the day. Goldman Sachs made $200 million that one day.
As the market went down.
As it went down in a big way. So don't look at these corrections and bear markets or crashes as bad things. Just look at them as an opportunity in a different direction if you know how to take advantage of them. Because the markets don't go up. Even if you have an upward trend or a downward trend, it's never a straight line. Things always kind of move in a stair-step fashion. So there's always opportunities to take advantage of.
And here's a good question for you, Al. I mean, the public is so conditioned that the market does go up all the time. So you want to also be with the trend as well. So there's opportunities as markets drop, maybe to get in, maybe to get out, but also shorting, right?
Absolutely. Yeah, the mentality it's a buy mentality. It's a buy, go long, sit back and don't worry about things mentality. It's really, that's how Wall Street has conditioned us. But that's not what they're doing, and that's not where the opportunities are. If you're just holding something that only has the opportunity of being in your favor if it goes up in value, then you're missing out on 2/3 of the trading opportunities because the market goes down and it does go sideways. So, if you're in the market and your goal is to identify buying and selling opportunities and be prepared to take advantage of them, well, how do you do that? Well, the great thing for us, Josh, and the listeners, is that the institutions determine if there is a buying or a selling opportunity.
Yeah.
And because of how they have to enter or exit a trade or the market, they leave a trail that we can use to know in advance where they will be active. And it's because of the fact that they are trading in such large volumes that they can't get everything filled, whether they're going into a trade or out of it at one time. They have to do it in increments. And that's what our core strategy really was built around, taking advantage of that fact and knowing in advance. And this is the key. It's knowing in advance when the institutions are going to be active.
Well, it's really designed to identify that.
Exactly. And a lot of people will say that sounds like a timing mechanism. And
no, we can't say that word. But
well, we're going to say it. And that's exactly what it is. It's timing with a high degree of accuracy, institutional activity. And it's important. That's important because the institutions, again, trade with such large volumes that they move price. They really can control the price. So, and here's really what the key is. The smart money is the money that's being invested by Wall Street elites. And they have a massive amount of resources to get access to market information before the rest of us get it, or maybe we never get it, giving them a massive advantage. So if we know where that smart money is trading, when they're going to trade, we can just follow their activities, their action. And that's a great thing we want to keep this simplified. Keep it as simple as possible. Don't overcomplicate things, which is what most people do. They try to learn 5 or 10 or 15 different foundational strategies. You don't need to do that. Keep it simple. Identify the one thing that really is workable and usable on a repeatable and a reliable basis. And as long as these institutions are in business, as long as Wall Street is in business, that activity will be repeatable, and it's something that we can rely on. That's what gives you the edge and the opportunity to, have the ability to benefit from what the market's doing, no matter what it's doing.
Yeah, that's the key word, is having an edge. I mean, most people, and think about this, if you have traded or invested in the past, how many different indicators and strategies and different things have you looked at? I mean, people look at earnings reports. They do all this research, right? Well, Al, what does that really just create? It creates an opinion.
Right.
And opinions don't drive the market. It's the institutions, like Al's talking about. It's the smart money, the Goldman Sachs, the Wall Street elites, as he was talking about. They're the ones that decide to move the market. It takes millions and billions of dollars to do that. So as Al was talking about with the core strategy, it's a strategy that's designed to follow that trail on what the institutions are leaving behind. And Al, you talk more about and explain, I guess, what that trail really looks like, how to identify, put in the odds in your favor, gaining an edge in the financial market. Al, we got a fun packed show here today. I want to continue this discussion on the Wall Street elites, as you were saying, the smart money. They're the ones that are creating the moves in the market. And I want to talk more about supply and demand in the next segment, how that really works in the financial markets, but also how the institutions or the smart money, how they are creating income. Now, those techniques and those strategies are also available to us, the public. This is Josh and Al, Investing with Confidence. We will be right back.